Alright, let's jump right in. Welcome to today's explainer, where we're taking something that frustrates almost every single retail trader out there, candlestick patterns, and completely turning it on its head. If you've ever felt like the market is personally out to get you, well, this is exactly what you need to hear. Our goal today is simple but incredibly powerful. We are going to decode candlestick psychology. We're totally tossing out the complicated textbook jargon, and instead we're going to view these charts as what they truly are, in the most simple, easy-to-understand language possible. It's just a real-time tug-of-war between buyers and sellers. Here's our quick roadmap for today. 1. The candlestick illusion. 2. Anatomy of a candle. 3. The big momentum trap. 4. Reversals and indecision. And 5. Smart trading tools. Section 1. The candlestick illusion. Why memorizing patterns just fails. So why do textbook candlestick patterns constantly fail? I know you've asked yourself this. You study the charts, right? You see a market trading in a range, it breaks down, and boom, it forms a perfect bearish engulfing pattern. Every textbook on the planet says this is exactly where you enter a short trade. So you jump in. And what happens? The market immediately reverses, the price spikes, and your stop loss just gets completely wiped out. Why does this keep happening when literally everyone knows these textbook patterns? Well, the answer is actually incredibly simple. You're getting trapped by the psychology of the chart. The truth is, big institutional traders know exactly what textbook patterns you're looking for. They use these super predictable setups to create panic and trigger your FOMO, that fear of missing out. They deliberately push the price just enough to trigger your textbook entry, which generates the exact liquidity they need to execute their massive orders in the opposite direction. So you aren't failing because you read the pattern wrong. You're failing because the pattern itself was a trap. Moving on to Section 2, Anatomy of a Candle. It's really just buyers versus sellers. Let's forget all the fancy jargon for a second. Think of a single candlestick as a quick boxing round between buyers and sellers. Step 1 is the open. Ding ding, the bell rings, the battle begins. Step 2 is the high. This is the absolute maximum distance the buyers manage to push the price up during that time frame. Step 3 is the low, the maximum downward push by the sellers. And finally, Step 4, the close. This tells us who actually won the round. If the close is way above the open, the buyers dominated. Way below, sellers took the prize. It really is that straightforward. Now, timeframes can easily play tricks on your mind. Just imagine looking at a 5-minute chart. You see 3 frantic red candles dropping lower and lower. It looks like immense selling pressure, right? You're probably thinking, man, I need to short this immediately. But wait, if you simply zoom out and combine those exact same 3 candles into a single 15-minute time frame, you might see that the price opened and closed at the exact same level. The 5-minute illusion showed total panic, but the 15-minute reality reveals complete market indecision. Neither buyers nor sellers actually have control. Crazy, right? Section 3, the big momentum trap. Beware the big body. Okay, let's talk about the momentum candle. This is that massive candle with a huge body that shows what looks like total one-sided dominance by either buyers or sellers. It usually happens during high volatility, but listen closely to this. More often than not, this big, beautiful candle is a deliberate illusion. Institutions literally create these massive moves to emotionally manipulate you into jumping into the market out of pure FOMO. Let's walk through exactly how painful this trap really is using an example from the Nifty 50 chart. So, minute 1, the market is just in boring consolidation, nothing happening. Then, minute 5, suddenly a massive bullish momentum candle breaks out of the range. It looks so convincing. Retail traders get massive FOMO and just rush in to buy. Minute 10, the big institutions step in. They've secured the liquidity they need from all those buying retail traders, and they violently reverse the price downwards. By minute 15, all those retail stop losses are hit. The source data actually shows traders getting trapped like this up to 3 times in a single morning. So the absolute key takeaway here is, when you see an abnormally large momentum candle, just stay away. It is highly likely a trap. Section 4, Reversals and Indecision. We are learning to read the wicks. Alright, here we have the reversal candle, sometimes called a hammer. It has a small body but a very long wick. And you know what? That wick is your new best friend. It is the literal footprint of a completely failed push by the opposing side. For example, say you see price dropping toward a major psychological level, like 25,000 on the Nifty, and suddenly a candle forms with a massive wick pointing down. Well, that tells a story. It means sellers tried with all their might to push the price lower, but a swarm of buyers aggressively stepped in, rejected it, and pushed the price all the way back up to the open. It's a massive failure for the sellers. Then we have the indecision candle. This is when you see long wicks on both the top and the bottom, and the body is tiny, right smack in the middle. This signifies total, absolute market confusion. Neither the buyers nor the sellers can figure out which way to go. You will almost always see these pop up right at the tail end of a very strong trend. The volatility dies down, the momentum fades, and the market just starts printing these indecision candles. When you see this, whatever you do, do not guess the direction. Wait for a clear breakout above or below that indecision zone. Let's tie all of the psychology together, making it as simple and easy to understand as possible. Instead of memorizing 50 different animal-themed candlestick patterns, I just want you to remember these 3 core psychological traits. A momentum candle has a big body. It signals dominance, but beware, because it's often a trap. A reversal candle has a long wick, which absolutely screams price rejection. And an indecision candle has wicks on both sides, indicating pure market confusion. If you start reading charts through these 3 simple lenses, dominance, rejection, and confusion, you are literally going to fundamentally change how you trade. Thank you so much for joining me on this explainer. Now go out there and read those charts like a pro.